Now, in terms of profit-taking methodology, as a facet of trade management, just a couple of the mechanisms for exiting a profitable trade. I'm sure there are loads more that I missed. Take profit order being filled, obviously. Manually closing a position at market. And then a stop order above entry if long or below entry if short. So basically an onside, a stop that's been moved into profit being executed. So technically, you can trade and never take profit, and instead continually move your stop as the market moves in your favor until you are stopped out in profit, right? So let's look at a 4-hour chart example, not a live trade of mine or anything, but just something structurally that makes sense. Let's say you got long on the breakout through this consolidation here. One moment. This consolidation here, or this range breaks out. You decide to get long, and then you anticipate a trending environment, so you trail your stop under each swing low. This would be the first one, then price come down, make another swing here, and then here, etc., right? So you'd never technically have to take profit on the position, because all you do is move your stop up. Good chance you'd get taken out here, then you can always get back in, etc., etc. That's, forget the specifics, it's kind of the structure we're looking at of not having a fixed take profit, saying, okay, I'm going to trade from this range to this level here, but rather saying, okay, we've broken out of the range, decent argument for a trending environment there, so I'm just going to keep moving my stops up until I'm taken out. Okay, now what are the risks with that approach to profit taking? Well, it assumes a trending environment, first of all. It also assumes that clear levels for new invalidation will form, which isn't always the case. And lastly, obvious areas for trailed stops often get tagged prior to trend continuation. We saw an example briefly, or an arguable example of that in the Bitcoin chart, but generally whenever you get very, very clean technical trends, higher highs and higher lows, there will often be some event, kind of a shakeout or even a deep trend retest, whatever you want to call it, which will knock those participants out of the dominant trend if they've been employing a very simple kind of trailing stop strategy, right? Now, there's no right or wrong way, but it depends on your trading style and market conditions, among other factors. Whether you kind of move stops or explicitly take profit. That's why I've got the verses depicted as such, because it's not a strict dichotomy between those two things. They're not mutually exclusive. So a trend following system in a trending market, you're more likely, I think, to capture a bigger portion of a trend with trailing stops. Because if you are indeed in a dominant trending environment, why would you try to catch the top or even give up a good entry if levels of resistance are being broken as price is making higher highs and higher lows? At the same time, a more kind of mean reverting, or I suppose a orthodox, or what most people would understand when I say a swing trading system, maybe in a ranging environment, fixed profit taking, a range boundaries or ATR, or however you want to delineate the range, or where you might anticipate resistance, that makes more sense there, right? So for example, if you have a ranging environment, price trading between two levels, if you manage to get long near the range low, your objective or profit taking area will be the range high. Because judging by preceding price action, if you've got no good reason to believe the range is going to break out, if you don't take profit at the range high, all you risk is price returning to your entry or even stopping you out. Okay? So, trade management, specifically the profit-taking side of things, or moving stops, or however you want to, paying yourself, however described, it's unlikely that you find long-term success with just one system for all instruments, all time frames, and all market conditions. You should have at least a couple in your toolkit. One to be able to catch and not give up entries if the market's moving in bigger waves, if you will. And one for kind of bracketing or range-bound environments where you don't get too greedy and take the level-to-level trades. Okay? Another important consideration from the risk management video, and again, I first came across Tom's articulation of dynamic risk-reward, or evolving R. And the premise here is that the risk-reward of a trade is not static. It adjusts as soon as the trade is live and price moves away from entry, so it's a dynamic calculation. So the question to ask yourself as the trade is developing is is the risk reward of the trade still reasonable in its current state, not the state during which the trade was taken at first, right? If you take a 1 to 2 risk to reward trade and then price moves significantly towards target or significantly towards your stop loss, that risk reward has changed as price has changed. And one way to think about it is the following kind of thought exercise, if you will. If someone offered you the current price, your current stop loss order, and your current take profit order as a trade, right now, would you take it? And if the answer is yes, then that's good. So your risk reward and trade management is reasonable. If the answer is no, now what I've written here is quite extreme, that, well, yes, the risk reward of the trade is less favorable, so manage it, either by moving stop loss order and or by taking profits. It's not always going to be an impetus to manage the trade, but it's to keep you thinking about the dynamic nature of risk reward in a trade. So let's look at just a quick trading view example without anything specific. Let's say you enter a long position. Okay. With these, you know what, let's make slightly better risk reward here. Risk reward of 2. Okay, forget all this. This is our trade. Risk reward of 2. Entry, stop loss, target. And then price moves in your favor and moves, let's say, to this level. So now we're technically recalculating the risk reward because this is your entry. Your take profit is the same. And your stop loss, if unadjusted, is also the same. So when the trade started, your risk reward ratio, or you had an R on the trade of 2, right? You'd make double whatever you're risking on the trade, you know, fees, commissions, etc., if the trade were to go to target uninterrupted. Now, if you let the trade come this close to target, so move from this point to this point, and you haven't moved your stop or done anything to manage the trade, then you are risking this much extra profit at the expense of a full-size loss all the way down here, right? So you can see the risk-reward calculation becomes unreasonable. Now, that doesn't mean if you move your stop, it has to then match 2 or be some amazing risk-reward at all times, but this is just to get you thinking in the right mindset that when I took the trade, the risk-reward was fantastic, now it has progressed to this level, and if I do not change anything, either take some profits or move up my stop or manage the trade in some way, suddenly the existing risk-reward of the position is not reasonable. I don't think any reasonable person, if I asked you as a fresh trade and offered you an entry here, a target here, and a stop loss here, most people wouldn't take that. Reasonably so. But if you're in it, if you took this trade and price gets to this point and you haven't changed anything, that is the trade you are essentially agreeing to. Because price is under no obligation to hit your take profit order. It doesn't care about you. It doesn't know who you are, right? So it could reach this level. You only have this much left on the table in terms of profit for this much risk, and then it reverses on you and takes you out. Okay, so it's always important to be cognizant of the dynamic nature of risk reward and how it changes both in terms of price approaching target, but also in terms of price approaching your stop loss, as mentioned in the preceding section. Okay. As I said, dynamic risk reward is also especially important, at least in my experience with trading Bitcoin, when you really get on side with a big thrust candle, so an expansive, engulfing candle with a big range, essentially. And the same considerations then creep in. How close is the trade to target? Where is the nearest structure I could use to define my risk, if any? And if there's no new invalidation level whilst being so close to target, as we covered in that example there, is the risk reward justifiable? And here's another example you could kind of draw yourself. I sort of did a different one on TradingView, but 20-point stop, 40-point target, price moves 35 points in one candle, 5 from target, right? So at that point, you can see the change in the risk reward, given its dynamic. It's gone from a 2R trade, and then suddenly you are risking the entire position for an extra 5 points of profit, at which point that is unreasonable. And again, it's not like you have 2R in the first trade, and then you measure your dynamic risk reward and it's not very good, and you say, oh my gosh, I have to move my stop or take profit to make it to turn it back to 2R. It doesn't work that way. You don't have to kind of restore it to its original value. It's just to get you thinking about the trade and managing it so that you don't give up gains unnecessarily, and you certainly don't take your position for granted. So the risk reward is always evolving in trade management. Okay. Another very contentious facet of trade management, risk-free trades. Okay, so the premise is moving a trade to break even as soon as possible after it moves positively away from entry, so in your direction. And so the idea is doing that removes all risk from the trade. It becomes a free trade. Okay? Now, when does moving to break even make sense, at least in my view? Two main scenarios, really one, which is the first one. The second one I think is arguable. The first one is when your technical invalidation level for the position aligns with the entry price. And again, unless you've got a really good entry, that tends to be quite rare that you get that almost perfect alignment. Okay? And as we'll see in the next section, even that's not always perfect or a good idea. Now, the second scenario is where price has moved significantly away from entry, but not provided a new invalidation level. So that could arguably be that example at the bottom of this page here, where your price moves in one candle, basically to your take profit order. What do you do? Now, honestly, for my personal trading, in those cases where price gets really close to my take profit, starts showing signs of reversal, and I've got nowhere to define my risk and nowhere to move my stop, I'll usually just cut the trade. I'd rather leave that extra, 2, 5, even 10% of profit and get out of the trade rather than let it come back to me and take me out break even, given I've not been able to define my risk elsewhere. Okay? But you could certainly make the argument that when those scenarios happen, break even is justifiable. I'm personally not convinced, but I'm happy to share the argument with you. Now, reasons to be skeptical of automatically moving to break even, I think there are a few. The first is that it's not risk-free. Now, the actual technical exchange mechanics aside of, fees and slippage and all of that kind of stuff, assuming perfect order execution, which certainly isn't guaranteed, from a technical point of view, the risk, it doesn't become risk-free, it's just the nature of the risk changes when you move your stop to break even. The risk becomes getting stopped out while still being right before your idea can materialize. So you're essentially not giving your idea a chance to play out. You're not letting yourself be correct. And that applies in many types of technical setups. And we'll cover one in a moment. But it's especially true, as you can see in the second point, in my experience, price will very often retest technical structures, especially if they are high time frame levels. It may look on a weekly chart the price came into a zone, wicked into it, and then reversed. It looks fantastic, easy. But often, if you look at that same weekly wick on, let's say, a 4-hour, hourly, any intraday time frame, you'll actually see multiple tests of that structure before it eventually leads to a move that does its job. I'm sure you can go on my Twitter or other feeds and find examples of this, but roughly what it looks like structurally, if I may, is you have your high time frame level. So this is high time frame, okay? And then we're on an hourly chart. So price will trade into the level. Then initially, the first impulse will usually, give you some sort of decent reaction if price has reached a key level. And at this point, traders who sold into it will be quite happy with that and say, wow, market was trending up, looking beautiful, hit the level and fell. That should be the top because this level's done its job. And what they'll do is move their stop to break even or slightly in profit even, okay, and saying, well, look, we've pulled back from high time frame resistance. That's it. It's done its job. And then often what will happen is price will pull back, maybe spike the high, come back, maybe give some distributive price action before then falling off and giving the real impulsive move as opposed to the initial impulsive move. Now, what all of this looks like on a weekly time frame, as mentioned, it looks very easy. It just looks like a wick and then price turning away. But on an intraday basis, you get these sort of scenarios where you end up selling, or you essentially end up buying resistance, right? That's kind of the point I'm making with this point here. Not only will price very often retest technical structures, but you end up buying the resistance you sold or selling the support that you bought, right? Just to make that very clear, we've got a high time frame level here, okay? Prices come into it, sold off, and you move your stop to the level, if you're short with a stop market order, if that gets triggered, that's an order to buy at market. So what are you doing in essence? You are buying at resistance. Okay? Especially again, when you're dealing with intraday price action at high time frame levels, these sorts of retests, spikes, distributions, etc., they'll be very obvious on intraday time frame, but on the higher time frames, it'll just look like a wick. But if you end up giving too much weight to this initial impulse, right, the first reaction, and then you immediately move your protective stop into profit or break even, if that thing gets executed, you end up buying resistance as you get stopped out of your short at the same level that you sold initially, which doesn't make any sense to me, at least. Okay. And finally, a slightly separate point is you're fettering your discretion and abandoning your technical trading framework if you just automatically move to break even without having a technical basis for doing so. Okay? As mentioned, it's not automatically the case. Sometimes if your entry is really good, it will align. But in many cases, it's just a coping mechanism. The market doesn't know or care where your break-even level is. You have the technicals to guide you for your trade identification, for your trade entry, all of those things, where you look to take profit. So why is it suddenly that when it comes to trade management and your stop placement, the technicals go out the window to make you feel good? And indeed, as mentioned in the previous example, you end up doing the opposite of your technicals. By moving your stop to break even, you end up buying the resistance that you were selling at first. Just worth being cognizant of. So some trade management psychology and tips. These aren't perfect. I've kind of tried to summarize bits and pieces and bring it together, so maybe rewatching the video will be better for you. So focus on good trading. So the trading process, following rules or a framework. Now, I understand some viewers might be confused. I'm talking a lot about discretion, but then talking a lot about rules. How do you square that circle? It's not very easy. I found one of two ways tends to kind of take over. The newer traders usually start by being fully discretionary, then they get pretty systematic, okay, as they develop a framework from their trading journal, etc., come up with strict rules and scenarios, etc., and then they either stick to that and remain kind of on the more systematic side of manual discretionary trading. So it's still manual, they still have some input, but for the most part, it's much clearer and more explicit what they look for and what they can trade and how to manage it. And on the other side of the spectrum is, again, those who started off very discretionary, toyed around or spent an early portion of their trading career on the systematic side, and then with screen time and with experience, lent more towards discretion, which is kind of where I find myself and many of the guys that I trade with. Okay? But just to make that clear, there's no contradiction between developing and following rules in the framework and at the same time exercising discretion. There's nothing wrong there. Now, in terms of focusing on good trading, the trading process, trading your P&L becomes an emotionally driven and actually worse, an unreplicable endeavor. The whole benefit of technical trading is kind of know what it looks like to some extent, and you can replicate it, you can backtest it, you can know roughly when setups are similar, okay, if you're more on the discretion side of things, you know what to see, whereas if you're trading your P&L, your emotions at the time, your exact sizing, the numbers on the screen, how quickly your P&L changes, none of that is easily replicable. So that makes it harder to trade well. And as has been a recurring theme throughout this video, the market does not know or care about your trade parameters. They're irrelevant. And as we saw in the previous example, in the previous slide, you might think you're doing good risk management by setting your stop to break even at that high time frame level, but from a technical point of view, you are buying the resistance that you first sold, or selling the support that you first bought, being the inverse example of that. Now there's the question about a good entry, sort of how important is a good entry for trade management? Somewhat, I would say, at least it's not irrelevant. So anecdotally, I think for anyone and everyone I've talked to, and certainly for me, it's easier to manage trades which take less heat, right? If you get a nice entry and then price reacts well to it, you're probably going to give it a bit more leeway in developing. You're less likely to overmanage those positions, okay? That doesn't mean you set your stop to break even automatically, right? Certainly, it's more likely that you can justify doing so, but it still shouldn't be the automatic reflex. But as I said, anecdotally, casually, it's kind of less stress. You get some early indication that you're on the right side of the market, given it's impulsive in your favor. It helps. It helps. Another tip, especially after watching a trade management video, is make sure there's something to manage. There's a bit of a dead zone, I've called it, between your stop loss and your take profit once the position's live. And your job there is kind of to do nothing. Price will kind of oscillate a bit and give you a bit of heat, then go onside, give you a bit of heat. At a certain point, yes, you'll start doing your evidence building or evidence assessment. Is this aligned? Is it doing what I expected to? Does this trade still make sense? Etc., etc. But really, especially soon after entry, there's a good chance that for a bit, depending on the timeframes that you trade, there's nothing for you to manage. So let your idea play out and let the market kind of digest, which is a terrible word to use in trading, but here we are. Make sure there's something to manage. And certainly if your time frame game is terrible, if you've taken a daily time frame trade and then you're suddenly on the M15 trying to move your stop, don't. Especially with high time frames, things can really change in like one candle when dealing with high time frame levels if you're on the right side of them. So patience is especially warranted in those areas. The last one, again, quite behavioral. The market doesn't know or care whether you've been losing or winning. Again, a tricky one in terms of discretion versus being systematic, but trading in contravention to your established system based on previous trades is sacrificing good process for P&L comfort. Not sustainable, not recommended. Trade your system, trade well. Do what you know is good trading, right? Execute your profitable system. And if the market's kind of been scratching you and, you've been mismanaging other trades, the market doesn't know that you've been mismanaging other trades. So why don't you just start doing it properly? Psychologically, it's very difficult, right? Let's say you get a big win. Let's say you've been getting scratched in a session, minus 0.1R, fees, all that type of stuff. And then you get a runner, one that makes up for all the preceding losers. And your system is telling you to hold it, but you might want to close it because, oh my god, my UPNL, I can make back everything I've lost. I would say in those circumstances, as far as you can, defer to the established system and the process, right? The high quality trading process rather than trading your P&L. Okay? If you can, just trade without your P&L at all, right? Assuming you can still size properly. But once you're in with your risk parameters, just get that thing off your charts. Probably not going to help you. Okay? Conclusion. By the way, I cannot believe I've recorded this in my first take. I hope I didn't jinx it. But trade management is not easy. Okay? Screen time and live experience are irreplaceable. Your trading journal, all these factors that come around in a live environment, those are going to be far more valuable than YouTube videos, books, webinars, whatever you want to call them. Okay? Even from a paper trading point of view, if you can, with money you can afford to lose, even live managing any sum, ideally a non-trivial sum that you can afford to lose, but any kind of live trade management will just give you experience that you wouldn't get elsewhere, even with paper trading. There's just something different about it. Try it out if you haven't. Okay? Again, risky, you can lose all your money, etc., but if it's something that you can invest towards learning trade management, an amount you can easily afford to lose, I think you'll learn much quicker than doing it purely by paper trading. The second point, again, we're kind of summing up recurring themes in the conclusion, is if you're a manual trader with room for discretion, use it, right? It's to your benefit, ideally, if you've employed this type of trading style. And as we saw in the chart examples, we like to reassess and reevaluate the trade with fresh eyes in terms of price developments as well as risk reward, right? Is this resistance acting as resistance? Is this support acting as support? Is price behaving at this level as it should be if my trade idea is correct? And if it is the risk reward, which adjusts dynamically, if I recalculate that, does the trade still make sense? So this whole process of trade management is all very live, dynamic, and relies on you, right? It's not something that, the trade is filled, it's trigger, and then you leave and that's it. You're in God's hands, all of that type of stuff. That's not how it works. Again, maybe it is in rare cases. Maybe you are that person watching this video who overmanages all of his trades, and maybe set and forget for you and your specific system works well. But I'm fairly confident that many people would benefit from looking into trade management practices, and I'm sure there are trades that you could have gotten out of early or closed in time that went against you that could have gone better if you had a trade management framework. I say that with a reasonably high degree of confidence. Okay? So if you have room for discretion in your system, use it. Trade the chart, not your P&L. I'm not going to bang on about that, but again, the long-term focus should be on the trading process. Trade well, and if you do that, the rest tends to align. Okay? At least if you trade well, and even if the P&L stuff isn't aligning, you know what to work on. You've got replicable, clear data on what you're doing, rather than the emotional swings that come with P&L trading. And for me personally, just on a finishing note, the kind of things that go through my head, as you saw in those examples, when I'm in a position or looking to get positioned, is price action developing as I would reasonably expect it to, if my trade idea is correct? And what is the evidence for or against my position? In a kind of cringy way, I think about it as almost from a law point of view. What are the arguments, or debate? What are the arguments for? What are the arguments against? Have the arguments shifted in one side? And where is kind of the evidence pointing towards on balance? And that's trade management for me in a nutshell.